quite a long time actually, since last time we had you guys. It's my pleasure to have you here at BSCA Europe. And by the way, we stressed this so many times. It's about our association. We guest speeches from all over the world on a regular basis, every 2 weeks, basically. This has been the very first year that we tried this kind of format that we will consolidate in 2023. So today, it's my pleasure to have again the guys from Void team, Void Defi, namely, and Drew in particular, talking about tokenized debt and something really new in a very traditional world such as trade finance. So won't lose too many minutes in chat to say I'll leave the stage to you guys and to Lee, namely, to kick this meeting off so we can start hearing from you. I'm very interested and honored for your presence today. Guys, stage is yours.
Cool. Thanks, Andrea. Thanks for having us. My name's Lee. I'm CEO of Void Finance. And I'll let you introduce the rest of my team. I'll let them go introduce themselves.
Yep. So my name's Andrew Liao. I'm the Chief Financial Officer for Voy. My background is mostly in hedge funds and fund accounting and financial products and things like that. And so I've been in the crypto space for quite a long time. Yeah, I'm just excited for what can come up, the new future and everything like that. So I'll pass on to Dave next.
Yeah, thanks, Drew. I'm Dave Hopkins. I'm the Chief Operational Officer at Void Finance. My background is chiefly in commodities trading. I've done many different roles in the sort of mid-office, back office, in derivatives and also with physical commodities. And so I've been fortunate enough to get involved in quite a few for quite a few years, physical in trade finance, and I'm very grateful for this opportunity to be involved in this exciting project. So Arzu.
Thank you, Dave. I'm Arzu. My background is in international banking. I worked in several institutions. In my special area is trade finance, international borrowing, international debt finance, and project finance. I have been engaged in blockchain ecosystem for the last 4 or 5 years. I've been involved in blockchain through an academic research that I did during my MBA. And I'm very excited to be involved in Void project as well, and glad to be here with you today.
Cool, thanks, Arzu. So a bit about my background. So my background is traditionally as a broker, FX, swaps, and as part of that journey, touching into finance, a couple of years back, partnered up with Andrew, and we touched on an area that we felt was ripe for disruption, evolution, growth, however you kind of want to categorize it, and that being trade finance with all its many flaws, paper-based, etc. So we kind of looked at trying to evolve it into a digital space, a tokenized space on blockchain. Problem was back then was it was an immature arena, so it was very difficult to try and put all the pieces together. And everyone was kind of like, "How are you going to achieve this?" Right? And it was difficult. So as time has gone on, as many people will have seen, there's been changes in legislation from British governments and digitization with International Chamber of Commerce. So that kind of led us on to the whole ability to touch into tokenization and evolve from ships, bills of lading and other documentation, as well as the whole ability to tokenize and bring it to this digital arena that we are now seeing ourselves in for this digital revolution. And part of that, and as we're going to touch on today, is the use of NFTs, so tokenizing debt, and the use of NFTs. Now, as you can see by the picture that's up now, NFTs, everyone kind of goes NFTs, you know, Bored Ape and all of that. Well, actually, it's actually good that it happened, because the natural progression of everything is kind of like underground, and then it progresses into like a mature arena, which we've seen with blockchain traditionally, unregulated, etc., and then come into sort of this corporate use. The same thing with what's happened with NFTs. It's came out of this big whole thing with, you know, ability to use for imagery and art, etc. But what we found is that with this evolution and this the regulatory space, we've been able to take these what's being used as these funny NFTs, strange pictures, so we're able to take it into this new digital era of being able to apply it to what we're focused on, which is trade finance, the ability to tokenize that debt with various elements that are within the supply chain life cycle, and be able to actually throw it into what we're seeing now, and the ability for us to deploy it, to tokenize debt, putting all of this documentation together, to being able to, you know, what I'll do is rather than me go into this, what I'll have everyone do is, for their individual piece, go into and explain the benefits and how we're using tokens into trade finance and solve many of the problems. One of those being trade finance debt and other areas that are deeply embedded within trade finance. So I'll pass you on to Dave.
Yeah, thanks, Lee. So let's start off with a question of why we need trade finance. So the trading goods creates jobs, drives economic growth, and contributes to the GDP of an economy, and it improves people's lives. Now, more than 80% of global trade requires financing, and without trade finance, global trade would basically grind to a halt. So, you know, we can see trade finance we need. Yeah, thanks, Trey. So we come up against this phenomenon of the trade finance gap, which is essentially the difference between the amount of trade finance that's needed and requested globally, and the actual value of trade finance, which is provided by lending institutions. Now, this gap in 2020 reached $1.7 trillion. So we can see that this we're presented with a massive opportunity to gain significant rewards for anybody who can help solve the trade finance gap. Okay, if we can have it over, there we go. The unmet demand for trade finance is only increasing. ADB Bank estimate that by the end of 2022, the TFG, the trade finance gap, will be in excess of $2 trillion. So massive, massive sums. And what we've seen is that the trade finance gap actually hits small and medium-sized enterprises the hardest. SMEs represent something like 90% of companies globally, and they're key drivers of economic growth and jobs, especially in developing economies. But when we look at trade finance applications, SMEs account for something like 41% around the world, but they make up 52% of all trade finance rejections, or the application rejections. So what are the contributing factors to the TFG? We start really with the financial crisis in 2008-09, when the big international banks drastically reduced their capital flows and their geographical risk exposure. they shifted their focus to larger clients in developed markets, tightening of compliance and regulatory environments hasn't helped. Then we got hit with COVID, when the risk appetite just basically fell off a cliff. With the associated reduction in credit lines, and now we're seeing inflation cutting into the effective lending limits as the price of goods soars. So financial institutions consider the cost, complexity, and risk return in financing for SMEs, and basically ask themselves, why bother? So how can technology assist? We know that trade finance is an analog business which is struggling to work, to operate in the digital age. But digitalization in global trade, along with integration of blockchain and tokenization, will improve trust, transparency. We'll get automation of manual processes that will accelerate processing speeds, reduce errors. We'll get enhanced data transparency. Fraud will be reduced through immutable and accessible audit trails. The rate of recycling of capital for financiers will increase, and ultimately the financing risk will reduce. And this will open a route for greater SME participation in the trade financing industry. So, Drew, over to you. Arzu, I beg your pardon.
No, no worries, no worries. Thank you, Dave. As we all know, the status quo in banking and trade finance right now is not at its best. SMEs, as Dave mentioned, account for almost 90% of companies around the world, but most of them lack access to affordable trade finance due to different reasons, but mainly because banks are unable to meet all the demands. In principle, banks tend to focus on large companies which have established onboarding processes, credit histories, and of course, lesser impact on their cost of capital. Another big hurdle for SMEs is the rating issue. Banks and corporate credit ratings are limited by sovereign ratings. So unfortunately, they cannot overcome this hurdle, and this creates a big challenge, especially for companies in emerging countries. Geographic, political, and macroeconomic restrictions also fuel the imbalance. With tokenized letters of credit, tokenization and smart contracts, they provide automation of remittance, collection and closing, immutable custody. Ownership can be verified in a transparent way. Credit records are verifiable and again immutable. KYC and AML are completed during the onboarding process and they are traceable. And also DeFi and tokenization coupled together, they allow the possibility to remodel certain banking products which are already available. And also they provide access to a wide array of financiers on DeFi platforms. So basically DeFi is the connection between liquidity and trade finance and financing the trade finance gap. So some of the benefits of tokenized that are, they just make that become more easily tradable. Tokenization makes that fractionalized. It can be quickly and easily transferred. Intermediaries are eliminated. Connected with smart contracts, the default risk is minimized through atomic settlements and delivery versus payment methods. Processes are automated, human error risk is lowered, actually minimized, and automated audit functions provide historical record of all activities for each customer. Transaction costs and settlement times are reduced. And most importantly, short-term financing and quicker cash turnover is enabled for both banks and SMEs. Another very important advantage of tokenization and tokenized debt it makes it much easier to syndicate and co-finance loans. Syndications right now require extensive due diligence, as the process is often led by several banks, and the underlying costs related to documentation and legal expenses usually do not justify small amounts. So the loans are structured for larger tickets, larger ticket transactions. So with tokenized debt, the access to due diligence is made much easier and faster and secure, regardless of the underlying amount. So that opens the door to SMEs to access co-finance options, both with banks and in DeFi platforms. And this way they can immediately spread out exposure and risk. So how banks and SMEs can make most of tokenization is there are various advantages for both sides, but major benefits for the banks are they can expand their customer bases. There is regulated onboarding, which makes banks' lives much easier. They can access to untapped markets and also access to tradable assets outside of interbank markets. For the SMEs, post and pre-financing options can be increased. Their transactions costs are decreased. They gain access to finance through banks and DeFi platforms. They can create early payment options and increase their negotiation possibilities. And also hurdles related to sovereign rating can be overcome easily. So users can choose their counterparties based on their own risk and appetite. Risk appetite and costs and margins on DeFi platforms. Cross-border payments can be completed in minutes. And last but not the least, ESG and sustainability can be monitored through stored data and smart contracts, which also creates the opportunity to generate new products such as green bonds. So from here, I will just pass it on to Andrew to explain how DeFi is evolving in banking and finance.
Thank you, Arzu. Yeah, so look, there's so many, as you can see, there's so many benefits to banking, to tokenization of debt and everything like that, especially around the banking side of things, right? But at the end of the day, there's the core principles here where there's two core problems in trade finance in order to tackle all this that we need to cover, right? And so risk being the first one, nearly all trade finance is bank financed, and banks have low risk tolerance, and ultimately SMEs are high risk. That's one thing that we've worked on to de-risk a lot of the contracts for SMEs. Now, the second piece of it, and this is where I think DeFi and NFTs can really shine, is the liquidity problem. Currently, affiliate banking processes spread out the risk, but it's slow, and it ultimately bottlenecks the liquidity flow. And obviously, like turnover of cash matters because it ultimately affects profitability. Banks see low-hanging fruit first, right? So any lower risk SMEs, that's who they're, or lower risks or corporates, that's who they're going to fund first. And by the time they get to these higher risk SMEs, there's just no more liquidity remaining. So how do we solve that problem, right? And I think we believe DeFi is the answer here, right? Because ultimately DeFi can bridge new sources of liquidity. So DeFi introduces new sources of liquidity outside of traditional bank finance, aka sort of the crypto liquidity, right? That's sitting in this market. I mean, there's over 42 billion, there's nearly $42 billion right now of total value locked within the DeFi ecosystem as a whole. DeFi enables syndicated co-financing, distributes the default risk, so it goes back to that risk piece. DeFi lowers the custodial risk of funds because it's secured by transparent, audited small contracts and immutable blockchain ledgers. Like you guys all know this, being from blockchain association, right? And at the end of the day, and especially around sort of recent developments, DeFi has been battle hardened. DeFi investments actually increased, and despite some of the contagion risk and the collapse in trust, talking about all the FTX situation and everything like that, DeFi investment has continued on, and because it's decentralized. So the retail appetite for DeFi is absolutely significant. We can see that it still exists. But the important key point here is to bring in banks, because at the end of the day, retail can't survive, can't spur on a whole new industry on their own. You need both pieces. You need the retail piece and the banking piece together. And so by building DeFi to allow for secure institutional third-party custodial access, we can actually create like an inclusive system which both parties can actually participate in. And that's where we come to how we do things differently, right? Because ultimately, the majority of existing DeFi protocols, they really only lend within themselves, within the crypto economy, the crypto ecosystem, and they create yields, they generate yields based off of leveraging tokens. But these tokens were basically created out of thin air, by their own sort of companies. This is exactly what happened with FTX. It creates industry-wide exposure to any single one contagion, right? So with everything that we can see, FTX was essentially created FTT tokens. They leveraged it onto their books, lend it throughout the ecosystem, and now the emperor has no clothing, and now the whole system is kind of falling apart. So how do we see us bridging the gap? How do we make this in a way that works, right? We see there's two sides to this. There's the liquidity side, and then there's the contract corporate side, right? So on one side, we have crypto liquidity. That crypto liquidity is staked into a TVL, into the staking program. And then those funds are then controlled by a DAO onto the marketplace. And I'll get into more details here in a minute. On the other side, we have the corporate side of things. So we have trade contracts and everything like that. The voice system is able to tokenize a lot of these trade contracts. And then that and all those related documents, as Arzu had touched on, is then wrapped up into an NFT. Now these two pieces can now meet on the marketplace, where now we can have liquidity meet the business. And it just going into a little bit more detail, right? Ultimately, we initially looked at kind of traditional financial structures as a basic framework. So how do we sort of bridge this gap from going from the traditional methodologies into an bank acceptable DeFi structure? And the way this works is we break it down into pieces, right? So the TVL, the total value locked, which is in the staking programs and farming programs, it's roughly analogous to a traditional fund's NAV, right? The net asset value of that hedge fund. How do we then control those funds? Well, traditionally it's an investment manager or an advisor but so from the DeFi point of view, we use a DAO, which is a decentralized autonomous organization. They're able to control the TVL funds. Through farming and staking, we're able to generate LP tokens. These LP tokens are essentially votes for DAO governance. So anybody who kind of puts their money into this staking and increasing the TVL also then has a say in where this TVL money goes to. Tokenized trade finance contracts, right, come in from the other side. They're listed on the marketplace for buyers that seek financing, and then that essentially provides debt financing opportunities. And the important part then on the other side is that each of these sort of contracts have segregated LPs, so liquidity pools for each trade contract. So similar to the way how reinsurance funds and things like that segregate out their investments to keep them safe from the others, we can do the same thing here with liquidity pools and trade contracts. And now, as Lee had mentioned, we're looking beyond monkey JPEGs and art and things like that. NFTs at its core, they're non-fungible tokens, which means they're specifically identifiable. Now, it's very important because they're ultimately, it's a container, right? So NFTs are a Web3 compatible container that can wrap up particular, that point to a particular collection of data, right? In our case, it's going to be data that's on the blockchain. So you have things like tokenized bills of lading, AML, KYC, letters of credit, ESG reports, sanction screening, all these things that are related to a specific trade can now be wrapped up in a single NFT and referenced, right? NFTs can then be fractionalized, they can be repackaged. This debt can now be easily traded and transferred. It creates an immutable audit trail, provenance, all these things that we know are benefits from blockchain now can be applied to a singular NFT, which is a collection of all the trade data for a single sort of trade contract, right? And the most important thing is that because of the origins of where we started with this, we allow for bank compliant documentation. That's very important for adoption. So trade finance and SME markets, right? At the end of the day, they're starved for liquidity. There's a massive opportunity here to service. Voy is able to then connect new liquidity with an untapped market through DeFi. this crypto liquidity is able to actually meet the trade finance gap and actually service this. So the next stage of that is making sure that it's bank compliant, because bank compliant DeFi allows for retail and bank participation, and industry-wide change can occur from there, right? So Voi's ecosystem enables the tokenization of debt, trade documents. It brings, allows not just digitization, but tokenization, because that ultimately allows us to wrap these assets, the contracts and everything else in an NFT. It's a convenient Web3 compatible package. And why does Web3 compatibility matter? Well, because now you can apply smart contracts, you can allow for automation, you can do things like automatic remittance, and everything like that, the speed and efficiency of automation. And at the end of the day, all these things, all these sort of factors put together will usher in an industry-wide evolution. So that, in a nutshell, that's kind of where we see DeFi, trade finance, NFTs. That's our vision of where things are moving. So with that, if there's any questions from the audience or anywhere else, anyone who's interested in kind of more details about what we're doing, please feel free to ask questions now or reach out to us separately. And I just want to thank you again, Andrea, for putting this on, as well as the everybody else that's here listening today. Thank you.
Drew, it's my pleasure to have you here with us today, by the way. This is very interesting. By the way, what you're doing as a company is really innovative. And I can tell you, especially you see tokenization common concept is very new. And as I said at the early start of the meeting, it's like, you see, trying to, let's say, lead the industry, and I mean trade finance, into 21st century, while it's still stuck, needless to say, on almost Renaissance ways of doing things. Exactly the same flow, the same working methods, although we have evoluted over the centuries. What struck me seriously in the concept is inclusion. So how to let small, medium, and often micro companies step into the picture of international trade. This, I would like to, we've been talking about a lot of inclusion, how to fill in the gap. Two things: other institutions besides banks, and new working flows in the space. Think about a simple LLC, and you've been working in the bank. You know how tricky it is to process an LLC. And I ask myself often, how can small and micro companies go through an LLC? It's not only for having the facility underlying an LLC, but when you have an LLC, how can this LLC be processed without incurring in bank reserves? And we know, these kind of things happen.
So one of our beliefs here is that, like you were mentioning, around inclusion and participation, right? Because in order to move the industry forward, everyone needs to be involved. It's a big industry. It's a big process. End-to-end supply chain is massive, right? And so it's not just a matter of one player, two players. Everyone needs to buy in, and everyone needs to be involved in order for the whole industry to move forward, right? And so how do we get, and so to your core question of how do we get sort of these small SMEs on board and doing all this stuff, when costs are high and everything like that. And I think the answer to that is standardization, right? Because by creating this sort of end-to-end hub on the Void platform, all different players, depending on whatever their needs are, can come to this platform and get the data that they need. So for example, like logistics companies, they're able to come in, see the shipping data, see where things are moving, see where the status of things are, and they're able to participate in their sort of portion, their niche of the supply chain. And similarly, if we have standardized sort of forms, standardized digitization, tokenization, and everything like that, all these sort of smaller SMEs, rather than having to come up with and create and process LLCs on their own, they're able to essentially input the data that they're seeking, what they need. Financiers are able to come discover them and finance them through an automated process that happens in the background, because at the end of the day, it's just about data processing. And so if we're able to standardize the data, the inputs coming in on one side, we can then streamline, in a procedural basis, all the different steps that need to happen. If something is missing, it can be requested automatically, right? Automation, like all these things get requested, and as soon as the input comes in, the process can move forward automatically. And that ultimately removes a lot of the manpower and a lot of the necessary sort of knowledge base and connections that are needed for these SMEs to participate, because now they can leverage all the bank knowledge, all the major bank sort of procedures and processes and safeguards. They're all built into the system.
Think about nowadays LC. 2 out of 3 LCs do require modification, the so-called amendments. So it takes the central bank, I mean the central headquarters of the bank, to process the message, send it to the branch, that send it to the advising bank. Wow, hang on, such heavy load of work. So what we have to convey as message is that, hey, we're massively reducing this amount of work. It's the so-called ergonomy being drastically cut out. You said it very well, by the way, by quoting 2 words: data, transparency. It's a full transparent process where none of the stakeholders is excluded. So all in, I think about what's going on, you see, in the words of standards and standardization nowadays. I recently read a report that goes into the direction you mentioned: get standardized to boost transparency, because most of the stakeholders involved in the supply chain are nowadays left blindfolded most of the time. And I can tell you, working on the corporate side is some kind of frustrating. Where are we with the issue, with the ELC issuance? Where are we with the payment? You can streamline all this process nowadays. You can optimize all these processes by bringing in smart contracts, by bringing in the power of blockchain. So, I mean, it's struggle, but it's a big opportunity to convert nowadays operations into digital. Was wondering to ask you, how do you see these new products within new frameworks being fostered nowadays on both sides of the ocean? We're going to talk about this specifically during the last meeting of 2022, and namely URDTT by ICC UK and the LPC by BAFT in the USA. How do you see these 2 new frameworks stepping in the picture of digitalized trade finance through?
Yeah, I mean, if you're talking about the USA in particular, and a lot of sort of the larger first world nations, obviously, I think there's something to be said about following regulation and getting a better understanding of where even the regulatory lines lay, right? So that's one of the things that you kind of have to consider. But the way I see it, if you look at kind of where trade finance and supply chain everything kind of is, it goes back to, look, we're still using archaic processes, we're still using paper-based processes, we're still doing things that are very manually intensive, manual verifications and things like that. But at the end of the day, the core principle of supply chain is, it's all process driven, right? It's process based. It's nearly linear, and that lends perfectly to digitization, to automation, and everything like that. And so as long as you can follow regulatory guidelines and you can follow all that, there's no reason why the industry as a whole can't embrace this and move forward with it together. And again, the challenge in my mind is that we need everyone to move forward together. Because if you have, say, only at the very beginning of the process is digitalized and tokenized, and there's massive innovation there, but then everybody else still requires paper-based products, well, you kind of lose, the benefits drop off, right? Because then you got to convert it back to paper-based, and then you're back to the whole, the whole old inefficient system. And so the way I sort of see and envision this moving forward is a mass adoption. And how do you get a mass adoption? It's bringing everybody together to the table, getting everybody's opinions on what they need, what they distill down the core needs of each stakeholder, and then applying digital processes to that. And so,
Awesome, thanks, Drew. I invite people attending. I mean, in attendance, don't be afraid and post your questions. It's very interesting and it's a very, very wide topic we're touching today. And also, Rick, I know Rick is involved in standardization, chair of ISO Standards Association.
Yeah, and also speaking around sort of standardization and all of that, again, kind of adding to what you were talking about with how do we move this industry forward and things like that. Our vision of NFTs and how that will look. I think it's very important to point out that, look, at the end of the day, when you have so many disparate pieces of information and pieces and items, it makes it very difficult to create a specific sort of process, because, for example, like bills of lading, could have a lot of different data fields. Some bills of lading will have certain things, others won't. Some will call something one thing, and then on the next bill of lading it'll be called something else. The idea there is, if we can then standardize all these data fields, plug them in to a tokenized system, then wrap it all up in an NFT. And that's the key point here. If we're able to wrap all of this up in an NFT, a lot of the transfer problems and a lot of the sort of post-financing issues, things like that, go away. Because in the traditional sense, originally, if you want to say fractionalize a certain trade debt or something and pass it on, well, there's a whole process. You have to analyze all the different underlying pieces of data, and in order to actually sort of package it and resell it. But with an NFT system built in place, all you need is that NFT's identifier, right? Because that identifier is the entirety of the trade contract. That includes everything in a standardized sort of a way, so you can analyze those items on a very quick, holistic sort of viewpoint. And then when you do need to make a change in title or anything like that, it's a simple matter of transferring the NFT. And so the efficiencies that you gain, that opens up human capital, that opens up,
You touch on a very interesting point again, Andrew. NFTs at the early start, you see that you see all this funny drawings. But again, let's go deeper into the concept. We're not talking about that. We're talking about no fungible tokens.
Exactly.
So something that give you right to something else, and it's unique in very poor words. So when I first heard about NFTs, no fungible token, the very first thing that came up to my mind was first bills of lading. Have you ever seen a bill of lading that is equal to another one? I mean, a 50, I never seen that. Then second step is, hey, wait, what about the invoice? Same as before. So you have a bunch of information contained, a bunch of data contained therein. There are that make all these records / documents unique in its own way. So let's stress the fact that to boost adoption of these new tools, we're talking about two things that maybe have the same origin, but hey, that's totally new world. It's not about speculation. It's not like that. It's something that can really allow the industry to step into a whole new era. So this is great. I mean,
absolutely. I mean, Lee touched on this earlier in our introduction, right? Where he talked about the maturity of the space. And that's exactly what we're seeing here, because yeah, the original idea usually kind of go for, of NFTs just being able to show ownership of a certain thing. The easiest way to, a very easy and quick sort of implementation is through artwork and art. And not bashing it or anything like that, but it's a very simple implementation. Now, as the industry, the greater crypto economy and everything is maturing, like larger players are getting into the space, we're seeing innovation and the maturity happening. And so when we focus then directly on the NFT space, we can see that, look, at the core principles of what an NFT is that it's a non-fungible token. It's specifically identifiable. So anything that requires a basket, a container, and identifiability is prime for NFT adoption. And so that's where we're trying to push the industry. We're trying to push, obviously we still have our roots in a lot of this sort of fun, crypto innovative, kind of maverick sort of stuff. But at the end of the day, to move the entire crypto industry forward, to move adoption, and to really move the needle on evolution of the digital age, this maturity has to happen, and we have to apply sort of mature products to these new innovative sort of solutions and packaging. And it's funny because Andrew, when you're talking about how do we the first thing that you thought of was bills of lading and NFTs. It's funny because we had that idea years ago, thinking the same thing, like, hey, this is a perfect application for this. And as we sort of built more products and built more things around it, and did sort of the whole thought process of going through and analyzing what's necessary and what's needed, we realized there's all kinds of documentation that's required, and there's all kinds of documentation that needs to be specifically identified. And so why not package this all together in an NFT, in something that that's specifically identifiable, tradable, fractionalizable, and all of that.
I can tell you one thing, Andrew. I've often been exposed, to critics stating that, the world trade needs evolution rather than revolution. I can agree. But every evolution, in my own vision, leads to a sort of revolution. If you evolve, you some kind of revolutionize. I want to make something swifter, nimbler in terms of process. You do make a revolution, needless to say. So we've been talking about LCs for centuries nowadays. It came out of a very nearby city, very close to me, with the Monte dei Paschi, and the 15th century. Now it's 21st century. Are we ready for new products? I mean, we heard about the BPO so many times. I heard critics about that. It was badly designed. So I can agree. Maybe it didn't find any adoption. It's zero dot. But leveraging on that hard lesson of BPO, bank payment obligation, what can we do next in order to have more accessible products for the small, medium companies all around the world? In the end, this is what we're trying to do, because we can revolutionize, we can evolve the process as much as possible. But in the end, if you really want to include, you have to revolutionize the process and give those companies new products. It happens in the retail world. Why shouldn't these happen in the corporate world?
Yeah, I think around that, like the evolution is where it starts, right? Because evolution is acceptable. Everyone can, generally speaking, most people will accept an improved version of what they know and what they have, as long as you can properly convey the benefits to them, right? And so evolution is a very easily acceptable thing. But stacked on top of each other, evolution after evolution after evolution, creates a sort of revolution. And the problem with stepping in directly with a revolution is that you alienate people, because you're creating such a massive change that it disrupts what's happening. On one hand, it is good, but again, it will create friction and will create resistance to change. However, small incremental evolutions stacked on top of each other for each individual stakeholder, in essence, in and of itself, will create a revolution without anyone ever actually realizing it, right? Suddenly, if every single stakeholder within the supply chain were to dip their toes into digitalization, dip their toes into tokenization, just take a little piece of benefit from their everyday workflow. Suddenly, if everyone were to do that, suddenly there's a revolution, because now the entire industry is most of the way in to this new digital world, this new tokenized Web3 compatible world. And as soon as they sort of take that first step and they see that one process suddenly being done significantly faster, with way more accuracy, with a lot more trust and security, they'll realize, wait a minute, why can't we just apply this to all our processes? Why can't we apply this to everything that we do and secure it all? And so that's how we see, that change kind of happening. It's going to be sort of an L curve sort of adoption, right? Where we slowly introduce incremental changes, but we're now reaching that point where we can see this take off, because if everybody's on board with just their little focus of the industry, the whole industry is going to move.
Yeah, I mean, the difficulty, and leading on from there, the difficulty that you have in supply chain is that word Andrew said is adoption. But what I think what we've seen due to COVID and geopolitical issues, let's call them, what's come apparent is a forced adoption. You've seen price increases, across the board, and you've seen slumps in trade. The only way that, which is why the ICC have coming on board and passed legislations with like UK governments, etc., is the only way that we can rise out of this, is to start to standardize and digitize processes. So the adoption is always difficult with supply chain, but I think that's what you're seeing is, from time some of the larger stakeholders, larger companies, corporates and tier ones come on board, and they see that the opportunity for growth, it starts to teeter down into tier 2, tier 3, which is where we're trying to focus on to try and help that adoption.
And there is another thing that I would love to point out, reference the word crypto space and the DeFi space. It's not devil there. There's a bunch of opportunities, good ones, supply chain and trade finance, basically. So it's good that we point out, and especially I like to see when you pointed out the flow that goes on being securitized, and it's, you see, much swifter. So I dearly appreciate that one, absolutely, in your presentation. But anyway, we'll leave it to the audience if any question have arisen. I saw some people, some folks, you see that showing up, now posting question. Well, were you clear enough? One more thing I was planning to ask you, Lee and Drew or Dave, who wants to take on this. We are talking about matching, and this comes from the first meeting, guys. We tried to match ESG and trade finance, which I found absolute genius, and I do embrace this fully, because new world and new way of doing things, and with so much focus here in the association into these topics. It's rather shifting. Sorry, Drew, then I'll leave the words to you. It's like shifting from what we are doing to how we are doing, that I find mostly fascinating. So it's stepping out of the old world of accounting to another level of accounting. Sorry, Drew, leave it unto you.
Totally okay. Absolutely. That's all right. This is something that we kind of touched on in the last time actually we spoke with you.
Yeah.
But it's worth talking about again here, because look, when it comes to like a revolution, when it comes to an evolution of things, why not add in things that we know can add benefits? Like why not add value add, right? So one of the, obviously over the course of however many years, ESG is becoming a big thing, becoming a big component of everyday business, not just for for everybody, not just the shippers, not just for logistics companies, not just for buyers, not just for sellers, everybody, right? And so so by integrating ESG into our product, it immediately gives you a platform. Whether if you don't want to use it, don't use it, but it's there and it can be applied And if it's there, why not use it, right? And why not apply that to for the greater good of all? Because ultimately that's the goal, right? Everyone lives in this world, and ESG, when applied correctly, can only benefit. And so, well, there's a lot of talk, and one of the things I do want to touch on is the concept of greenwashing, right? Because there's a lot of, while yes, it's a noble, ESG is a very noble sort of concept, a lot of people would then go and take advantage of that and try to greenwash things by simply just talking the talk, but not necessarily walking the walk, right? They'll talk about how they're so green and ESG, blah, 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 but there's no real substance to that. So what we've done is, by creating our scoring system, we're putting it on an immutable blockchain and things like that. The data is there, that these sort of requirements and what actually makes up ESG, we're able to sort of apply a rating for every single stakeholder. And now it's inescapable, right? You can't fake it. You can't pretend like, you're doing a lot of good when you're not. And so by holding people accountable, by holding each group accountable and having these ESG ratings on there, not only can you then ensure people are following ESG practices, but also being rewarded for good ESG practices. And I think that's a very key point. So things like, finance discounts for those who utilize other parties who would, have better ESG ratings. For example, like if you've got some goods that are on a ship, and and you decide to pick a ship which is has lower bilge water pollution than their peers, well, that will boost their ESG score, and we can then apply a certain discount to choosing providers with better ESG. And that will ultimately, because money talks, so that will ultimately force true adoption of real ESG and not just simple greenwashing.
You touched on a very, let's say, important pain point: greenwashing, and how to prevent this one. You can unlock take it, and I agree with you, by the way. Especially, my 2 cents, of course, if you let technology interact between them, it's not only about, blockchain any longer, and it's no longer about, IoTs. It's the perfect interaction between all these technologies. And as an association, we will be back on this topic soon, detailing what's going on in the space.
Let us know when that happens, because we have Steve. He's our ESG specialist. We have him on board on the team because we think this is a very important. So we'll love to have him come back and talk with you too.
I absolutely Steve will be with us.
And Andreas, it's funny you mentioned that point relative to the ESG, and obviously the topic has also been about SMEs. We had a meeting today with a certain team out in Dubai, and they were really interested in adopting their ESG solution. Because one of the things that really attracted them to the ESG as a pain point that's generally out there for trade finance was the percentage rate of rejection of SMEs, where we're talking like 60% rejection rate on trade and 80% rejection on female-owned businesses or female-owned SMEs. And they were really impressed with the fact that they could actually start to combat that. And that's obviously really another hot topic along with greenwashing.
You know what I find interesting in blockchain? Sorry for interrupting, by the way. When you fill in data in the blockchain, you take responsibility on what's been built. It's no longer a blank act. You take responsibility. So if you declare that you have women, that you have fair treatment, that you have anything from emission, anything, it's your own responsibility. You can no longer fake it, as Andrew said. So it's sort of, hey, you have the interest in being transparent and boosting your transparencies, because this will bring some advantages to your company and to your activity. At the start, as we talk about green bonds, it's just a portion. And by the way, how how loans, how syndication is important in trade funds. So this is the very interesting point of what we're talking about today. We're not only acting on processing, we acting on origination of deals in accordance with the SDG, by the way, Sustainable Development Goals by the UN. So this is, it's no surprise to me that in Dubai, they're really interested. You see, all these topics are extremely important to do that.
And also on that note, there's Andres, which I don't think we've covered, is that with the use of these of our ESG solution or our Web3 ESG app, what we also do is with certification. So an NFT, which is an NFT certification of their ESG scoring. So that ties into the whole, another use of tokenization that we push out.
Awesome, Lee. This is awesome. I think we come in the top of the hour. It was great talking to you guys again. It's a perfect follow-up of what we discussed about on November 3rd, the hyperledger trade funds, the supply chain of trade funds sake. And I really love this. Being so much exposed to traditional trade funds products, I really do like what you in the middle of doing. So thanks for being with us today. I'll leave back to you, Eric, if you want to add anything on your end. Are you there, Eric?
Hey, folks. Thanks for joining. Great session today. Great conversations. I always struggle with this word. Democratization of all that we do on a daily basis is super important. Headed in the right direction. Just a reminder, we'll email everyone the link to the YouTube recording and the slides probably early next week. So thanks for joining. Thanks for including me at the end here, Andrea, and look forward to the next one.
Perfect. See you in 2 weeks' time, and thanks for joining us today. Thanks, guys, from Voy. I really love this speech, and talk to you all soon again. Goodbye.
Thank you. Have a good one.
Cool.
You
Bye-bye.
too. Have a good one. Bye, guys.